Before we start, Andy, I just wanted to say a quick thank you to our podcast sponsors, Money Farm. Now, Money Farm are the largest digital wealth manager in Europe, and they create portfolios of ETFs for their clients. They're incredibly cheap and ideal for somebody who's wanting to get into investing, and perhaps for more experienced investors who don't actually want to run their own money anymore. Now, they will even offer to run the first £20,000 of any of our listeners' portfolio absolutely free if they enter the code MTTM20K into the website at moneyfarm.com. For more information, check out their website. But for now, Andy, let's get back on with the show.
Hello and welcome to episode 167 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leakes. Damien, welcome back. How are we doing?
I'm good, Andy. I'm surviving. It's the
surviving. That doesn't sound too positive. That's normally associated with someone who's had a bit of a hell of a week. Have you?
Well, I've had a slightly challenging week. I don't hide the fact I suffer from Crohn's. I've suffered for years, but this week I was. If you can imagine the word probed, is probably the most appropriate term you could imagine. Everything that you think of when I say that word is it's correct. So don't visualise it too much, but whatever leapt into your head when I said that word, that was most of my week. So
this podcast's taken a real turn. I didn't expect that in the first 2 minutes we'll be talking of the word probe, and I'd have such visions in my head as I have right now.
It's a powerful imagery. So it's not all bad. I'm not saying I enjoyed that, but I've been having various tests because I've been a little bit unwell. I think I mentioned it before the pod. I've been a little bit unwell before Christmas, and so it was test to check what's going on. It's like having an MOT, and it was a bit like my annual MOT, and it came back. So I've a bit like your car. I can probably survive for another year before I have to have another MOT. It's not like real MOTs where you can try and get the guy to fudge it, or you can just tweak a few light bulbs and things and hope it scrapes through. It's not quite like that. But yeah, so that was my week. But I'm now on Friday out the back end of it, for want of a better phrase, and I'm I didn't mean that actually then, but I'm very positive. So anybody who's emailed me this week, I've been slightly delayed or on Twitter, then that is why. So there you go. How was your week, Andy?
Well, I was going to say I've had a week from hell, and part of me does think I've actually had a worse week than you, even though what you've just described, because I'm no longer an IKEA virgin.
Are you not?
No, I bit the bullet last weekend and spent the evenings during this week putting together the stuff that we managed to somehow remove from their warehouse after walking what seemed to be about 7.8 miles. So I seem to be the only person on this earth that had never been to an IKEA. I'm assuming you've been to an IKEA before.
Yeah, I've been lost in IKEA many times. But actually, the guy who owned or created IKEA just died recently, and there was lots of coverage and some very interesting facts about the amount of piece of IKEA furniture the average person in Europe has, and it's basically such a huge success story. But before we move on that one. I always remember when I was at university, although I did a maths degree, we did a course that had a business element, and it was talking about case studies about operations management. And IKEA was the most amazing thing I'd ever seen on this case studies that we had. And it's deliberately made so you walked past every single item that they have. That's why you get lost. And they have no staff to keep costs down and keep you wanting. That's why you can't find an IKEA staff member, and you have to end up going all the way in through in the small bits at the end and all that. It's all planned, and you have to get your stuff off the shelves, all planned so they cut down warehouse costs. Absolute genius. So I kind of admire it, and the average time for the average person to be in IKEA was something ridiculous, like 4 to 5 hours. That was the average. So that just shows you. I once went with I may have told you this before. I once went years ago when I was going to buy a wardrobe. I went in at 11 o'clock in Croydon. There's a store. I went at 11 o'clock at night when it was still open, and I opened all the little secret doors so you can make shortcuts through. And I knew the wardrobe I wanted. I knew everything. And even though I sort of went in like a trolley dash right the way through to the end with all the details and got the wardrobe, it took me 1 hour to complete that. So even if you know what you want to get out. So anyway, there you go. We've given IKEA a nice advert.
Yeah. It was a real experience, and I probably would go back again.
How many screws did you have at the end left over? Mysterious screws that don't do anything.
At the end of this week, I did have many, and little wooden bits that you'd meant to put in, and washers, and so we had. I think we bought about 4 or 5 different bits of furniture that we've been needing to get for various different reasons. Yeah, lots left over, and so I'm sure it'll all collapse next week. But not one swear word uttered, and my wife and I, we didn't fall out, so that was a success, I suppose. Although we did fall out in IKEA, like most couples do. It seemed to be like the general sounds that you hear in IKEA is people asking for meatballs and people arguing. That's kind of all you can. That
is pretty much sums it up. Yeah, or it's people looking lost and confused.
Anyway, let's get back to the money stuff. What have we got coming up on this week's show?
This week we've got 3 pieces, potentially 4 actually, because one of them leads off from last week. But we've had some fantastic feedback about the pieces I've been doing on investment markets in the last couple of weeks. So I might give another little tidbit about what's going on now, which does make it slightly timely for people listening in the future, but will still be useful. So if you are enjoying the slightly more contemporary bits we're doing on investing, then do tweet in and say. If you don't, also tweet in and say, look, let's do something more general based. I'm going to talk about selling your house, and I'm also going to talk about the transcript of a model transcript of a scam that caught out 200 people and cost them £7.5 million jointly. That's been revealed, and there's some quite interesting psychology in how the scams work, so you can not fall foul of similar tricks.
Good. We starting with the investing this week?
We'll start with the investing, but before we do that, Andy, I know you've got a couple of reviews you want to read out. It's been hugely successful, us reading reviews at the start of the podcast to encourage others to do it, because we read their names out. So do you want to go for it, Andy?
Yeah, we've had a couple of really nice reviews this week. Thank you for doing that. If you want to get your name read out on the podcast, you know what you need to do. This is from Daniele F. Brilliant is the title. I stumbled across this podcast by accident when I started to become more interested in personal finance. It is sharp, informative, and is done with humour. Not sure I agree with that bit, Damien, but really accessible. Thank you. And another one this week was UK Based is the title from String Diddy. This is one of the best UK finance podcasts, a must hear. So thank you for those. Do please give us a review. It helps us to get up those iTunes charts. And actually our stats in the last couple of weeks has probably been the best ever. So thank you for that.
Yeah, that's been really good. And I said there was kind of almost a 4th piece. I'll just quickly do that before we move on. Now, David Withington is how you say his name, I think. I know he's been a regular listener of the podcast for a long, long time. He occasionally writes to me on Twitter, and he wrote in as a result of my piece last week about the energy miss, and we had a debate whether you should leave your heating on continually or just put it on a timer so it only heats your home when you're there, which was most cost effective. And he actually wrote in because he did a whole blog post and analysis on this fact. So if you want to go and find out what David found, I'll give you the sort of brief overview. He actually has a blog, and it's his name, davidwithington.com. He did a blog post on it, and he did some analysis. I admire him for this. He asked engineers, so he asked a boiler engineer what did he do, whether he left his heating on continually or turned it on and off with a timer to heat his home, which was most cost effective. The engineer said leave it on continually. The money experts out there, as became apparent last week when I did the piece, said no, you've got to leave it on a timer so it goes on and off only when you're in the house. And he actually sat there and tried and tested both methods with his gas, so not his electricity, just his gas, and heated his home for a week using both methods and worked out the cost. And he said it was actually best to continually leave your heating on at a low temperature, so rather than having that sort of feast and famine of heating. So there you go. We're none the wiser because David has just thrown the cat amongst the pigeons and just said it's the other. But as he says, you should test it yourself if you've got nothing better to do. So that's brilliant. So on to the investment markets anyway, Andy. Right, investing. So what I want to just quickly give a roundup of where we are in the investment markets. We had 2 episodes ago, we had the crash. We analysed what went on. We had last week, we had the rebound, and we're wondering whether we're going to fly higher and the potential other outcomes and market shapes of how they can dip immediately or test lows. So if you haven't heard that, go back and listen to it. But where we are now, the market is kind of stagnated. It's stuttering. It's trying to find a sense of direction. Now, if you can see that, particularly if you look in America, and the stock market has had days since we last did a podcast where it's generally had a downward trend. It's been fairly flat, but slightly to the downside. But it's had up days, but then followed by some similarly of equal size down days. So it is still a very much a caution element to what's going on out there. Now, this week we had the US Treasury dump or produce and put up for sale a lot more of their treasuries. So that's the equivalent of our gilts in the UK. So basically loans to the US government. And so by flooding the market with these, the laws of supply and demand mean that it tends to drive down the prices of the treasuries that are already out there in the market. It starts to, if you've got an oversupply of something, people tend to pay less for them. Then it pushed the yield up. And of course, go back and listen to the previous podcast. You know that yield figure was key. And that's what spooked the markets in the first place. So in the middle of this week, when all this oversupply, or extra supply, perhaps I should say, of these treasuries went into the market, it caused the markets to sort of get a little bit spooked again that rates and the general interest rate levels in the economy were rising in America, and equity markets took a bit of a wobble. So caution still abounds, but what I thought I would mention is people probably wonder, what do I look at when I wake up in the morning in this current environment? What am I interested in to get a steer where markets are going that day, that week? Because let's be honest, we're not day traders, so we don't really care what happens so much day to day because we're looking at the longer term. So one thing I would say is the US stock market. At the moment, it generally is a case that if America sneezes, the world catches a cold. But it's more so at the moment than ever because the US market led the sell-off, really. And the concerns are centred around the US economy and US interest rates and Treasury. So when you wake up in the morning, you might look at what happened in markets out of interest. Have a look at the US stock market. But one thing I would say is zoom in just out of interest and look at how the stock market performed during the day. Because what we're starting to see more of, and we touched upon it very briefly 2 weeks ago, we didn't make too much of a meal of it, but the markets are tending to open higher, and we're getting some quite significant rallies in the early part of trading in America, and then they're collapsing towards the end of the day. Now, generally, that's not a great sign for markets. It's not a particularly positive or constructive or bullish trend. It doesn't mean the world's ending, but it does show that there is some significant fear. And a lot of that is actually being driven by algorithms. And when I say that, I mean more of the large-scale ETFs and the automatic trades that are rebalancing at the end of the day. So you're getting a lot of computer trading going on that doesn't necessarily have human intervention. And that was shown this week because in America they had President's Day. I mean, I'm amazed they still have a President's Day based on who their president is, but they have a President's Day, which meant the markets were closed for human beings, but in reality there was still machine trading going on, and you could see that what happened that day followed that pattern quite closely. So they're having quite a significant influence on where markets end up. So where you might think that, that the market is looking like it's going to open higher because of the futures market is indicating that the market might open higher on a particular day, and it's all great. It's actually what happens in the last hour or two of the US market, which is probably more interesting at the moment because there's quite a lot of volatility and that hasn't disappeared. So at the moment, I'm kind of looking at that just to see how that pattern holds up, because it's just interesting ultimately, because if you want markets to go higher, you want to see that markets are really sustaining any form of enthusiasm throughout the day. The other thing I'm looking at, the 10-year Treasury yield we've talked about, where that's getting higher, that has actually got to the point where it's, I think, at a 9-year high. So it's up to nearly 2.95%, I think it went to. Now, 3% was the figure that everyone was worried about. But what is interesting, ignoring those numbers specifically, we're at a level that is above where we were 2-3 weeks ago, which sparked the initial sell-off that was exaggerated and amplified by those short products, those products betting against volatility in the market. Now, they blew up, so we don't have so much of that issue at the moment in the market. So the narrative has kind of changed. So people in the market are saying they're not so bothered now. Yes, the higher rates doesn't necessarily mean it's bad for the economy, and it doesn't mean it's bad for the stock market. So we have this trend in investing where people write a narrative that suits what they want to happen, and then when it all goes wrong, they change that narrative. So we've gone from higher rates is bad 2 weeks ago to higher rates is actually okay at the moment, and that will probably change. So I'm keep looking at that level, because when it does spike, it does cause wobbles in the market, but it's not quite causing as much fear as it did a few weeks ago. And of course the VIX is now, that fear index level is at the historic average, which is significantly higher than where it has been in the last few years, which is artificially low. So it's a bit high, but it's kind of stabilised at the moment. So that is again fairly interesting, that we're getting something that's returning a little bit more to long-term normals, but it means that we should expect bouts of volatility. Now, the thing that I also look at when I'm looking at the markets is what's going on in currency markets generally. Now, I do elaborate on this quite a lot in this week's newsletter, and for 80/20, so if you're interested, then you can have a free trial, you can read it. But there are certain things going on in currency markets that are starting to become quite interesting. When we had all the fear and all the wobble in recent weeks, we didn't see that translated from equity markets into bond markets into currency markets. And you're starting to see some interesting movements in currency markets, which are starting to dictate where equity markets go. So I won't elaborate too much on that, because that's for 80/20 investors, and it's exclusive. But what I would say is that keep an eye on the exchange rates, particularly between the dollar and the yen. That's having an influence on markets. And the final thing that I'm generally quite interested in, and for people more generally, for part of their portfolio construction, when they diversify, they tend to go for bonds. And we said last week how that has typically over time been a good diversifier. So equities and bonds used to prior to the financial crisis at least, move in kind of opposite directions. When one went up, the other went down to a certain degree. So it kind of balanced out and it reduced your risk. That is to a lesser extent these days, but in recent times, especially in recent weeks, you've seen the bond market collapse and the equity market collapse, which is a little bit worrying, because it means that the kind of all boats sinking at once scenario is occurring. So for me, I quite like to have a look at some of the broad-based index funds that are out there. So that can be things like L&G have some interesting multi-index funds. There are about 6 or 7 of them. BlackRock do. There's Vanguard have some, like their life strategy funds. And sometimes it's quite interesting to see how the US stock market has performed, and then maybe compare how those funds are performing, because they're very US focused and they tend to be led quite strongly by movements in currency markets, by movements in the US stock market, but also more importantly now, bond markets. So if you're seeing the US stock market do maybe be flat or up a little, yet these funds are heading lower, then you can see that is broadly showing you that bond markets are starting or continuing to fall and break down. And that's just quite interesting from a construction point of view, because you sit there and thinking, well, bonds aren't that great to diversify as they were. Now that correlation might be only temporary and change, but I quite like to see how some of those broad-based funds do, because at the moment they're not doing particularly well because of that correlation between equities and bonds, and when they're both going down, then they're both falling. So from an overall point of view, look at the US stock market. It tends to dictate where everybody else goes. Keep an eye on one or two of the currency exchanges, which I elaborate on in 80/20 Investor. And I would also look at some of these nice combination type portfolios you see out there, and even your own portfolio. See which parts of it are performing and not. So see how the bond funds are performing versus the equity funds, because then you can see that relationship shows you something more broader, how the market is behaving. And when they all fall at once, that's not a particularly good sign at all, but it doesn't mean you have to panic. But if you are deciding to try and reduce risk, then it's quite interesting, because it may be if that pattern continues, you might not want to diversify into bonds, and it may mean that you might want to take larger cash positions. But there are lots of good reasons why the market might sell off from here. There are lots of good reasons why it might rally from here. So we don't know. We're in that period of calm and caution, but it could just be an eye of a storm. So it's very interesting at the moment where we are in investing markets. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers, and the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, so the next piece is about quite an elaborate scam that seems to have caught out over 200 people to the tune of something like £7 million. And we've actually got an insight here into the script that was used. Damien, you've got more on this?
Yeah, what happened is Which, the magazine that tends to review lots of things, has published bits of a script from a past scam. Now, this scam occurred between 2008 and 2011, so it's some time ago, but it's the interesting psychology behind how they work. And the scam conned about 200 people out of around £7.5 million. And now the City of London police got hold of a model transcript that was part of this scam, and which have looked at it and published parts of it. And what is interesting is breaking it down into key elements of psychology. Now, before I started this podcast, Andy, I spent ages trawling through our past episodes, and now there are 167 of them now, to find an episode where I talked about a particular book called The Theory of Influence by a chap called Robert Cialdini, I think it said. I couldn't say it then, and I can't say it now. And he is a leading psychologist, and the book talked about the ways in which people can influence behaviour in humans, and in particular salesmen. So all the tricks that salesmen use to get you to part with your cash. But in addition, at that time, I was talking about how it could be used by fraudsters as well. Now, this is a wonderful example of how that idea and some of the ideas within that book, they obviously haven't taken that book, but just what the book described as the types of psychology were used in this con. Now, what I'll do, because I've read the book, I'll elaborate more than Which did onto how they work. But if you do find that podcast, go back. It will be one about fraudsters, scams, and sales techniques. It's really worth listening to, and the book itself is worth reading. It's an amazing piece of work that is very accessible, but just shows how we're fundamentally animals that are very easily influenced. Now, this particular scam was selling cheap agricultural land to typically elderly people at inflated rates. And it doesn't say why they did it, but I'm guessing it had something to do with inheritance tax, because there is some inheritance tax reliefs around agricultural land, but I don't know that for certain. But one of the first lines from this transcript they've pulled out is that they would speak to the victim or potential victim and say, so if you do love this market and I put a position your way on a spectacular plot in an area with government support, is there anyone else who may slow down your process of coming on board? Now, that is classed under the psychological behaviour of reciprocity, so reciprocal behaviour, basically. And to elaborate what they mean by that, if I do you a favour, Andy, you're more likely to do me one. And the idea behind this line, I don't buy it quite as much as they try to labour the point here, but that by doing the person a favour, they are doing you a favour by giving you this plot. Can you do them a favour by basically elbowing out anybody who might stop you? I think there's more likely to be reciprocal nature in these things. If somebody says that they've done you a favour by giving you this investment, could you suggest somebody else? Now that would be reciprocal, because you're doing them a favour. And that's why if you write an email to anybody and you ask for a favour, then you are more likely to be successful. And the reason that is true, if you read the book, it's because we're animals and we're a social animal. So we live in societies. We don't live on our own. And societies only work if the individual members can be relied upon to pull towards a greater cause. So if you imagine we're living in trees or caves, then it will only work if you do something and somebody else does something for you. And so therefore it's ingrained in us to do this. The other potential piece of psychology they use is something called consistency. And the line from the script they've pulled out says, and it's good to know that your investment is being helped by the government rather than hindered, isn't it? Now, this really, the consistency element relates more to the fact that they've given you something before, like a brochure, and they've sent it to you, and the fact that you've been consistent with a message that you've said before. So if you agree with something that somebody says, they give you a sentence, so it's good, isn't it? And you say yes, then what that means is that you automatically take on board the psychology, the notion that it is good, isn't it? That this investment is being backed by the government. Because you agree, it's very difficult for humans to disagree with something. They will hold on to something that they believe for as long as they can. And you might not realise you do it, but that's why you think, for example, Andy, Watford are a fantastic football team, and that's why I go and watch Tottenham every week, despite them not winning anything really in my lifetime.
Do you know what's really funny is that's the exact example I was going to use for you, but you beat me to it.
and it's when we pin our colours to the mast, we need to be consistent. So that's why you get people start having weird arguments. You know, you go for dinner around somebody's house and somebody says a point that is trying to be devil's advocate. Next minute they're in a full-blown argument and they're thinking at the end, I didn't actually even believe that. But once they start, they can't stop. And I've been at parties where that's happened.
And let's be honest, we've all got a friend who's got a higher propensity to be like that than others. We all know the person. Every single listener right now has got the name of that person in their head. Anyway, sorry, carry on.
And that consistency, again, which they don't elaborate on in this article, the reason that exists is because they need to be able to rely on your behaviour to be consistent. So if you imagine we're living in caves or we're encountering threats in the woods and all these things, they need to know that your behaviour is going to be consistent in a certain way, because if we were all erratic and we were all doing random things, then as a society we wouldn't work, and therefore we are successful as a species because we work as a collective. Now, the next one they pick out is social norms, and that is the tendency for us to believe something if other people believe the same thing. In a certain way. So if the piece of transcript is, we speak to individual investors who make their decisions based on their own good judgment and are liquid and ready to strike a bargain. And that again is trying to take the idea of other people, that social validation is the word I'm looking for, which is what things like Facebook and that are great and terrible for at the same time. We see it when it came to politics, didn't it? People can start validating opinions which are completely, or facts which are completely false, and they use that by trying to make out they've got other people who have already validated something. The other two which I'll whiz through is, by the way, please do call me Andy. I've got your first name down as Damien. Do you mind if I call you that? Or do I call you Damien? So the idea is that they get you to like them, and they break down barriers, being consistent and warm, and it encourages you to be friendly. And people struggle to break that once they start becoming friendly. It's a combination of that consistency and, again, that sort of reciprocating behaviour. When you like someone, you want to like them back. And so people and salesmen use this in techniques all the time.
I was going to say, I use exactly that phrase in business myself. I do think it's a nice friendly term to use so that you can get on friendly speaking terms, especially if there's a particularly difficult case you're talking about with a client. I do use that, and I'm slightly worried that The bad guys are too.
And the other thing that they tend to do is authority. So they will use authority figures. Sometimes they actually use some of illegally, like they probably talk about the FCA and stuff like that. But they'll use lines like, so you can clearly see how we secure a much safer position using our knowledge to offer the best locations. So in that instance, they were using their own authority and expertise, and that makes people feel better, that they understand what's going on. They're more likely to part with their money. And the last one is scarcity. Now, there is a tendency that we believe that scarce goods are better than those that aren't. So if everybody's a bit like us joining queues in England, if something is in demand and there's very few things of it, we think it's therefore good by the idea of scarcity. So they might say, now, unfortunately, we don't have anything currently available for someone new to the market, and be assured that, they'll give a name, Dave, who's a senior broker, will only call you should something come up that is perfect for you. And that idea of providing scarcity, which is, in this instance, played quite well, because it's not, you've got to do it today, they're doing it in a slightly different way, then that is causing people to obviously behave in a certain way and part with their money. Now, you might listen to this and think that you wouldn't fall foul of those things, but unfortunately we all do, and it happens to us all the time through advertising on TV. There are scams, and people are very smart, gets conned all the time. And I would just suggest to people, if you don't read that book, go back and listen to those few things that I've just talked about: scarcity, authority, liking, reciprocal behaviour, social norms, consistency, those sorts of ideas. See if you can spot them in advertising messages. See if you can spot them in any fraudulent emails you get. We all get fraudulent emails most of the time, but see if you can spot those, because they're the clever techniques that people use to part with your money. And if anything, it becomes more of a fun exercise to see them for what they are. And of course, like Andy says, there's nothing wrong with using psychology in life. We all do it, and even if we don't realise, when you touch somebody, you might touch them on the arm when you talk to them. That again is psychology. If people allow you to do that, if they allow that and are comfortable, they're much more likely to befriend you. So there you go. It's nice linking back to an old podcast, which I couldn't find, but there you go.
Good. Moving on to house buying, and we got a piece on perhaps the best time to put your house on the market. What we got here?
It's actually the best day, so it's going to be a nice short piece because we're at the end of the podcast. The best day to put your house on the market is apparently the 17th of March. Now, this was worked out by a company...
St. Patrick's Day.
Is it St. Patrick's Day, Andy?
It is. I think 17th of March is St. Patrick's Day. I'm sure if I've got this wrong, the listeners will lynch me. But no, I'm pretty sure it is. Yeah.
But if that's the case, then maybe there are a lot of people who are just drunk and put their house on the market and then end up doing that. Like a good friend of ours, Andy, do you remember? We may have mentioned it once on the podcast, but a good friend of ours once got very drunk, woke up in the morning, didn't realise what he'd done, and he'd actually booked a one-way ticket to Mexico to go and save the turtles on the beach. And I'm glad to say he obviously went, and
he never came back.
And he's never come back, and he's still there now, and he lives there, and I think he's got at least 2 children. He's married. I mean, that was probably at least 10, 11 years ago. So anyway, if you're out there, Dave, and you're listening from Mexico, I hope you and the turtles are doing well. The best day is the 17th of March. Now, how they work this out is pretty much finger in the air, but they looked at the land registry data, and the most transactions to go through for completed house sales is in June. So if you took the mid part of June, and then you work out what the average time to sell a house is, which is a statistic they know from a bunch of research, then that is 96 days is the UK average for somebody to sell their house. Now that means to put it on market and you end up completing. Now 96 days prior to the middle of June takes you to the 17th of March. So it really just shows to people that I think the date is largely incidental, but the timing, March, April, those periods, they are the peak times for selling your house. And if you might not know that, but if you speak to anybody in the estate agency world, that's the time they're busy, and probably the time they don't take any days off work, because everybody is looking to move and put their house on the market. So if you're looking to move, then now you're coming up to some of the best time to potentially shift your house.
Do Do you know what? That's a really interesting piece. And thinking about the psychology that we just were in the other piece there, thinking about the psychology of people moving, I imagine what happens in their lives is they think, right, let's get through Christmas, let's get through winter, the garden looks a mess, we can't do anything with the garden until the spring starts to come. The spring arrives and everyone does that traditional sort of spring clean, there's a bit of a spring in your step and you get moving. And I imagine psychologically, the weather gets a bit better, you've got through Christmas, right, let's get it sorted. It kind of all fits in, doesn't it?
Yeah, I think that's right. I think that's what it is. People do the garden, sort it all out, and then start to move. We had early on in the podcast, we've not done it for a long time actually, we had Liam on, one of the only people who's talked on the podcast other than me and you, talk about moving house. Maybe you're getting her on again at some point.
Yeah.
And yeah, you're right, Andy. I think that's what it largely is down to, and people can view houses in the daylight as well. Because I actually bought my house at that time of year.
There we go.
Anyway, there we go. Apparently the research says that. Who am I to judge?
Good. Well, we're done for another week. And if you want to get in touch with Damien, please do. It's Damien@moneytothemasses.com. Or, of course, get in touch with him on Twitter. He loves a good tweet. It's @moneytothemasses with a number 2. Do review the podcast, as we mentioned at the start. You may get your name read out. So, Damien, are we done?
We are done. Actually, just before we finish, Richard Darien, I want to say hello to you. Thank you for your kind comments on 80/20 Investor and the podcast, the last 2 podcasts we've done on investing as well. So I meant to read your name out at the beginning. I hope you're still listening to hear it at the end, but there you go. Until next week, Andy.
Until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.